Provisions with reserves. The key accounting difference explained simply. Welcome to today's video. We will break down two core accounting concepts, provisions and reserves. By the end of this tutorial, you will understand their differences, their impact on financial statements, and practical applications for businesses, startups, and freelancers. Even if you have struggled with these terms in exams or business bookkeeping, this step-by-step guide will make them crystal clear. Many businesses misreport provisions and reserves, leading to distorted profits or mismanaged funds. Understanding these concepts helps in better decision making whether you are managing your own business or preparing accounts professionally. Think of it as knowing the difference between budgeting for potential losses with setting aside earnings for future growth. It's a subtle but powerful skill. Here is a common question. Are provisions and reserves the same? Many beginners assume they are, but the difference affects profit calculations and decision making. Stay with me. We will uncover the distinctions clearly. A provision is a present obligation from a past event where the amount or timing is uncertain. Examples include warranty claims, bad debts, or pending lawsuits. Recording provisions help keep your financial statements realistic. This helps businesses avoid overestimating profit and prepares for future obligations. Reserves are profits set aside for future needs like expansion, contingencies, or asset replacement. Unlike provisions, reserves don't represent an obligation. They are a strategic allocation within shareholders' equity. Think of reserves as smart saving with provisions which are mandatory allowances. Here is a simple table to remember the differences. Provisions are mandatory for expected liabilities, say when obligation exists, while reserves are optional and strategic management decides. This distinction affects your balance sheet and profit reporting. For instance, if a business expects some customers won't pay $5,000, it records it as provision. Meanwhile, allocating $10,000 from profits for future expansion is a reserve. Provision reduces current year's profit. Reserve is allocated after profit is calculated. Small differences, big impact. Consider a startup selling electronics. A provision accounts for warranty claims you expect to pay. Separately, a reserve could fund next year's marketing campaigns. Both are forward looking, but one is mandatory, the other is strategic. When you record a provision, it shows up as a liability and reduces current profits. For example, a bad debt provision is an expense that ensures profits are not overstated. Reserves are allocations of retained earnings. They don't affect the reported profit but show how much profit the company has strategically set aside. For those who don't know, reserves are part of equity, not a separate external account. Both remain within shareholders' equity. Confusing provisions and reserves can distort profits and equity. Always record provisions when obligations are likely and allocate reserves with a clear purpose. Accuracy here improves financial clarity and decision making. Step by step, first identify expected obligations and create provisions. Next, assess discretionary profits and allocate reserves. Then record these accurately in your accounting system. Regular review ensures figures are realistic and actionable. Quiz. Which is a provision? Which is a reserve? Pass and think. Office upgrade fund is a reserve. It's strategic. Customer refunds are a provision. It's a liability. This helps reinforce the concept in real world terms. Key takeaways. Provisions protect your profit from unforeseen losses. Reserves prepare your business for growth. Apply these principles accurately, improves financial clarity for any organization, big or small. Share your experience with provisions and reserves in the comments. I would love to see real world examples. If you found this tutorial helpful, please like and subscribe. Thank you very much.